Imagine you've worked hard to build a 40 lakh portfolio in Nifty 50 shares. The market looks shaky, and you're worried a sudden crash could wipe out years of carefully managed savings. The strictly logical move is to buy a Nifty put option. Economically speaking, it acts exactly like an insurance policy to protect your hard-earned wealth. And from an Islamic perspective, managing genuine financial risk is actually encouraged. It's a concept known as tahawut, taking steps to protect the assets you own against real, foreseeable danger. But here is the roadblock. Even though you own real shares and have a valid need to protect them, the International Islamic Fiqh Academy considers the conventional option contract strictly impermissible. So we arrive at a confusing paradox. If the financial intent to protect your assets is perfectly halal, why is the specific instrument used by the rest of the financial world considered haram? To answer that, we must place a conventional options contract on the autopsy table, looking past its everyday use to dissect its structural DNA. Proponents often argue options are safe because your risk is strictly capped at the premium paid. But in Sharia, putting a ceiling on your potential loss doesn't automatically make a contract compliant. Then there's the argument about cash settlement, the idea that receiving real money at expiration makes the trade valid. However, receiving cash only describes how a deal ends. It tells us nothing about what the deal is at its core. Even if you take those options profits and immediately use them to buy physical gold coins, it doesn't solve the problem. The gold purchase might be fine on its own, but it doesn't retroactively legitimize the original transaction. The core issue remains. Superficial outcomes like capped downside or physical payouts are irrelevant if the underlying contract is structurally broken from the start. To find out if a contract is sound, we have to ask the single most important question in Islamic finance. What exactly am I buying and selling? When you buy an option, you aren't buying a tangible commodity. You are buying an abstract right, a standalone promise without physical backing. And here it fails. Islamic law doesn't recognize this floating right as a tradable asset. Contrast this with a farmer who wants to protect the future price of his wheat harvest. Instead of placing a speculative bet on market prices, he uses a contract directly tied to the actual physical grain he intends to deliver. Acceptable Islamic alternatives often use mechanisms like wad, a unilateral promise to enter into a transaction at a later date. Crucially, these promises are attached to genuine trades, not independent wagers. Effective risk management is entirely possible, but true Sharia compliance requires your hedge to be rooted in the exchange of tangible assets, not contractual illusions.
Which brings us back to your 40 lakh portfolio. Your exposure to the market is very real, and your desire to protect it is entirely justified. But a righteous intention cannot magically fix a flawed contract. The pure desire to preserve wealth doesn't wash away structural issues. It's similar to cashing out chips at a casino. The physical cash the cashier hands you is perfectly real money, but the system used to acquire it remains non-compliant. Economic logic and profit potential are incredibly convincing, but they are only half the equation when evaluating modern financial tools. To truly align your investments with your values, you have to look under the hood. You must always ask whether your financial shield is forged from a real asset or just an empty promise.